They shocked with stellar numbers as far as net adds were in the last quarter. This looks pretty good too versus expectations.
Yeah, it does. I mean, again, as we talk about here every quarter, this is a company that's really a momentum stock, and the momentum is really tied to the subscriber numbers, not necessarily the revenue or the EPS. No. This is the subscriber, and particularly the international subscribers, because that is where the growth has come over the last several quarters for this company, and it's where it certainly will come over the next several years. So to see strong international subscriber growth is probably the #1 key metric.
And in light of the price hikes that we talked about just as we were introducing.
Yeah, 10%.
Right, yeah. And I think we didn't see much churn here. It looks like from these numbers, but it looks like the company's keeping a cautious view in the fourth quarter as it relates to churn associated with this price hike. The fact that they didn't really raise the guidance for the full year, suggesting that the fourth quarter might come in a little bit below where the street was.
Well, I'm a Netflix subscriber. I didn't even realize that they raised prices on me.
Yeah, I was going to say. So what is it, like $2? Like historically, they're pretty good about being able to pass on price increase.
Yeah, I think they learned 4 or 5 years ago how not to do it, which is to surprise the marketplace. But I think now that they've kind of conditioned their consumer base to kind of $1 every year or two, and we see a lot of other OTT offerings out there in the marketplace from Hulu and Sling, and they all kind of have centered around this $10, $11, $12, $13, kind of price point. So this company seems to do in a pretty good path now every year or two to raise prices.
And you can see the stock has finally settled on a direction, at least for now. It is higher in after-hours trade, but still modest given where it tends to move historically.
Now, I know we just talk about these revenue numbers and then we treat the financials as this kind of afterthought, which is funny. Maybe we shouldn't do that. But the cash flow burn is still gigantic, and I think I read in our preview that they're $2.5 billion negative cash flow losses, and as long as they're growing like crazy, markets seem to tolerate it. But do they have to turn that around at some point?
Yeah, I think they do, and certainly if there is a bear case for a story that's up 60% this year after being up a gajillion% over the last several years, the bear case would kind of center on the fact that they are free cash flow negative. They lost $1.6 billion last year in free cash flow. It's a little over $2 billion projected for this year, and if you look at the Bloomberg terminal, it doesn't show consensus numbers out of Wall Street free cash flow positive until 2021. So how are they funding this $7 billion a year in programming expense? They're going to the bond market. But they can only do that for so long. But the bull case here is as they continue to add subscribers, they drive revenue, drive profits, and then ultimately that will drive free cash flow to fund the huge investments we're seeing in programming today.